with that, I'll call to order the Finance Committee meeting for Tuesday, April 24th. Are there any changes, additions to the agenda? None. I'll move the agenda be approved as presented. Those in favor? Opposed? Motion's carried unanimously. And we will look at the minutes of November 9th, 2017 Finance Committee. Are there errors or omissions? Seeing none, I'll move the minutes be adopted as presented. Those in favor? Opposed? Motion's carried unanimously. And we'll move right into item D1, the Town of Canmore Consolidated Financial Statements for the year ended December 31st, 2017. Ms. Van Kyn-Pima.
Good afternoon, Your Worship, members of the Finance Committee. I have to be careful, it's not council. So the first item on the agenda is a recommendation to accept the financial statements for December 31st, 2017. The financial statements have been prepared by our auditors, Avail LLP, in conjunction with us, so they assist us in getting it in the right format. And then they audit those financial statements, and we're here today to present them to you. Eagle Eye Councillor Sanford found a correction that needs to be made in the financial statements. Note 19 in regards to the Bow Valley Regional Waste Management Commission. That'd be easier if I put it up on the screen. It reads one way and it should read different numbers, a higher number. So what it was is there was one of the appropriations was included. One, I can't remember if it was recycling or waste management, and the other one was missed. So that's the correction. So when the time comes that we ask you to approve the financial statements, the ones that you will be approving would include this correction. So without further ado, to take you through the ins and outs of the exciting financial statements, I'd like to invite Mr. Calvin Scott, a partner with Avail LLP, and he's our file manager.
Mr. Scott, welcome.
No, but I can if you want.
Welcome to Council Chambers once again.
Thank you for having me.
Yeah.
I will lead you through a wonderful presentation. I don't know if they're necessary to have them up there or not. It's up to you.
It's your call. I just want to refer, and actually what I do is the page numbers of the agenda are here.
Okay.
So I'll leave this here and then
perfect. That'll be much easier. As always, I'll try to be as brief as possible for you. You get wonderful information on a regular basis in a far more understandable format than these financial statements. These financial statements are in public sector accounting standards, or following public sector accounting standards. The information you get follows more of a budgeting format, which shows capital and operating separately and makes a lot more sense. So I'm not going to go through all of these pages. I'll do the brief overview because I don't want to take up too much of your time. The statements we're looking at include not only the town's financial numbers, but also Canmore Community Housing, the library, and BRZ are all consolidated into these numbers. So there'll be certain things that are not there or are included that you wouldn't normally see in the non-consolidated financial statements. If you have questions at any point in time, feel free to stop me. We'll start with page 11. I believe it is. No, page 8. Sorry. Page 8 of your package, which is the Independent Auditor's Report. The Independent Auditor's Report states that the responsibility for these financial statements lies with management. They were prepared by management with information provided once again by management. Our responsibility as auditors is to ensure that the amounts and the disclosures in these statements are in line with public sector accounting standards. And our opinion is unmodified, or a clean opinion, which is what you're looking for. So they are in line with Canadian public sector accounting standards. The next page is the management report, which once again states that these statements were prepared by management and that you as a council are required to ensure that management fulfills its duties with regards to these statements. So ensuring that there are good internal controls and that management is doing their job. We'll now get into the numbers. First thing I'll take you to is going to be in your report, page 11. That's where I got eager to go to before. This is the statement of operations for the year, essentially an income statement, revenue and expenditures. The town this year on a consolidated basis had an increase of revenues of...
Sorry,
Yes.
I'm just going to interrupt because working from a paper copy, the page numbers are a little different than on the electronic. So that makes it a little trickier for you. So page 11 in my report.
Oh, so you have the actual numbers then. Perfect. We can do that.
Okay.
Page 4.
Page 4. Right you are. Thank you. You can just correct me every time. I'm confused.
Oh, we just looked at the bottom thing. We're going by the other numbers. That's fine.
Does.
So on the revenue side this year, an overall increase of $5 million, which is a good increase over last year. There was an increase in property taxes, which was budgeted for. User fees and sale of goods, we saw that go up almost $1 million, so increased usage and increased rates will account for that. We've seen that across municipalities this year, especially in water. It was a dry year, a lot more water usage going up. Another thing that went up was investment income. So as the town holds more funds and interest rates increase, there's been an increase in the amount of interest income earned pretty much across the board. Development levies and licenses and permits up significantly this year. As I was discussing earlier, you can drive through town and see all of the development that's happening. It's a great thing, and it's reflected in these statements with a significant increase in development levies during the year. And this relates, the majority of it's going to be the Northview Apartments, the Spring Creek Mountain Village, Cam Clark Ford, Base Camp Hotel, all of those are the major ones that came in. The other large one would be rental income that would have increased. MacArthur Place from housing is going to have a lot of the revenue associated with this, which leads to that increase in the revenue. On the overall basis, there is a significant amount of increase throughout the year. The other revenues are going to have $500,000 from insurance on the fire hall, and there's also $500 from Cam Clark Ford.
Would you rather we let you roll?
No, stop me anytime.
Later? Okay, so we interrupt with questions?
Absolutely.
You just mentioned that the investment income
Yes.
includes the revenues on MacArthur Place?
No, rentals. Rentals near the bottom, sorry.
Oh, sorry. Oh, down there, right. Sorry.
Yeah.
Thank you.
Good question, though. So yes, other revenues generally is going to be donations, insurance proceeds, those things that don't fall within all of the other categories kind of get squished into other. At the end of the day, there's $5 million increase in revenues, which is very significant, very healthy. So that's nice to see. On the expenditure side, an increase of $5 million in revenues will usually see a large increase in expenses. However, there was only a $1 million increase, or essentially a $1 million increase in the expenditure side. So it's wonderful to see that a much smaller increase on the expense side. So if you can see a $5 million increase in revenue and a $1 million increase in expenditures, you're looking at an increase in surplus operating, if you will, for $4 million for the year. Expenditures will vary from year to year, depending on amortization rates, what kind of repairs and maintenance are happening. There's also different costs that would be associated. So if we're running through all of the expenditures, the significant change would probably be other environmental use and protection. There was about a $700,000 change in there. There's some non-capital flood mitigation costs. So not all flood mitigation is going to be a capital expense. Some of it will be operating, and it falls in here, which is a significant portion of the increase in expenses for the year. The excess of revenue over expenditure shows at 5.7 this year as compared to 1.9. The limitations on these statements and why I say they're a little bit confusing. One, it's including all four entities' numbers. The second thing is that these numbers include some capital numbers and some operating numbers. So this statement includes the operating revenues and operating expenditures, but it also includes amortization, which is a significant number for the town. On an overall basis, on a consolidated basis, about $8.4 million of the expenditures that are included in this 47 are all non-cash expenditures. So that makes it a little bit hard to distinguish between what is operating and what's not. The other thing that's included on this statement below is capital revenues. However, the associated capital expenditures are not included on this statement. So generally, you'll see a large surplus here. However, a bunch of the surplus has already been spent on capital items. Yes?
I'm just running a little bit behind you here
You
now,
bet.
but I'm listening. So on the expense side, the public housing operation, the expense there is to some extent an offset on the rental income that's reflected on the revenue side.
Yes, with MacArthur Place running full-time, the expenses have
Right.
gone up in
So
there.
that's where the operating costs essentially of the CCHC show up in our consolidated statement,
Absolutely,
those two lines.
yes.
Thank you.
There are a few other lines, but very immaterial amounts that would be anywhere else. The last thing you'll note with this statement is that it also doesn't include any debt repayments or proceeds on debt, and nor does it include any transfers to or from reserves. So there's a lot of items that still happen within the municipality that are not reflected here. So in general, this statement would say that the town has a surplus of $16.9 million for the year. I think we can all agree that that's not a true surplus that occurred. So I'll take you 2 pages further, which will be page 6, which is the consolidated statement of cash flow, to give you a better idea of how this works. The excess of revenue or expenditures that we just talked about at 6.9, we pull out the non-cash items. So if there's a loss on disposal of capital assets, so getting rid of, replacing some roads, you don't get money in for that, but we do dispose of those assets. Accumulated amortization that I talked about before at $8.4 million, significant number, and that's essentially aging assets over time. The example of a building would have a 40-year life, so you purchase a building and over the next 40 years, you expense that 1/40th of it every year. And that's what amortization essentially is. Once you take out these non-cash items, the cash surplus was $24 million. When you look at it after that, there's accounts receivable that come in, so money that was due at the end of last year, accounts payable, which is money that is due at the end of this year. We look at changes in those accounts, deferred revenue as well, so that's any unspent restricted funds. A significant change in deferred revenue, so funds that were received but not spent this year. There's about $10.6 million worth of revenue that came in later in the year that hasn't been applied. So the cash flow from operating was $32 million this year, so that's a big increase on a cash basis when we look at it. With that $32 million, the town spent $16 million on capital assets. There was also $27 million moved into an investment account. $8 million came out of the investments as well. And then there was a repayment of debt for $2 million and new debt of $6.3 million. So the actual change in cash for the year was $4.6 million increase. And that is along with purchasing investments of $27,000. So that's what happened. That's where the actual cash from operations went to. Now this is on a consolidated basis, so this isn't the actual cash surplus. We'll deal with that after when Rick does the bridge analysis, which essentially takes you from these statements to the actual surplus for the town, and those numbers will be explained. So the actual surplus for the year, if we look at it, it's about 2.7 on a non-consolidated basis for the town. I'll now take you back to the statement of financial position, which is where the town sits as of December 31st. So this statement will tell you all of the assets, everything owned by the town, and everything owed by the town, which are the liabilities. So the cash and temporary investments had a $4 million increase that we just went through. Taxes and grants in place of taxes, there's about a 23% arrears balance on this. Across municipalities, we've been seeing an increase in both current and in arrears balances this year. A lot of late tax paying for various reasons, economy, whatever that might be, across the board, so it's not unusual to see. Your receivable balance on an overall basis has gone down, though. Trade and accounts receivables are amounts that are due to the town that have yet to be received. Generally, this is going to be grants. There's large grants that sit in there. However, in your case, there's about $1 million of offsite levies. There's $1.4 million of utilities that had yet to be received. There are upgrades, water treatment grants for about $370,000. GST sits at about $350,000. There's interest that's been accrued at $560,000, and some local improvement tax as well. So there's a significant number of funds that have yet to come into the town that are due as of December 31st. The investment in future housing developments comes from Canmore Community Housing, and that's related to the old daycare land, and that's the cost that has yet to be capitalized. So that'd be essentially the work in progress at this point in time. The investments, an increase this year, a significant increase over the year of 19, and that's due to the large amount of cash that came in that is unspent at this point in time. On the liability side, which is what is owed at the end of December, there is accounts payable are just amounts that have yet to be paid. So this is generally a timing issue depending on what capital projects are on the go. With housing projects on the go and other capital projects, this has increased from last year. The deferred revenue is where we see the unspent externally restricted revenue. So that had an increase of $11 million. And a lot of that relates to MSI funding, which is Municipal Sustainable Initiative for Capital, which you apply for specific projects. And until you do that project, the money just sits in deferred revenue and in the bank. And there's also $6 million for the Alberta Community Reliance Program. So again, specified funding that has to be spent, that had yet to be spent as of the end of December. So that is generally your $11 million increase from last year to this year. The net financial asset position has increased from 8.5 million to 19 million. So that's a significant increase. Yes.
Just on that note 8, the deferred revenue.
Yes.
So it notes in the deferred revenue all the funding that'll be coming on Cougar Creek from the FREC program. And now the federal grant, 14 million, isn't reflected in this page because?
The federal grant for
the same project?
This is going to be any funds that have been received and unspent.
So the FREC grant we've actually received, it's in the bank.
Correct, 15 million.
Federal grant is a promise, they still have the money.
Correct. And until there is something that we can agree to and it's actually more than a promise and it's a commitment, then it's not shown. And if it was at the commitment level, we would show it as receivable and deferred at that point in time.
But it literally changes hands at one point, as is shown with the 15 million in FREC.
Yes.
It's changed hands, we have the money in our account.
Correct.
Thanks.
So having the FREC of 15 million there has increased significantly the position. So the town is in a net asset position of 19 million compared to 8 of last year. So a significant increase in the financial well-being of the town from the prior year. Below this is going to be the tangible capital assets. So all of your engineered structures, your buildings, your roads, your underground water treatment. The big projects that happened this year, there was about 4 million spent on Spring Creek rehab, another 4.3 in MacArthur Place. There's about 2.8 in land transactions. There's about 3.4 in CIP additions, so like the bus storage facility, hazard mitigation, and another 1 million in the water treatment plant upgrade, and then various other small amounts that would have been put into tangible capital assets. This leaves the town at the end of the day with an accumulated surplus of 328 million as compared to 311 from last year. What's there? This is not money you can spend. A lot of this is already spent. So of this 328, 276 million has already been spent on capital assets. That's gone, it's been invested. 46 million has been put into reserves by council, which is wonderful, put away for operating capital purposes. There's 41 million sitting for capital and 5 for operating for future projects. And then there's an unrestricted reserve of 6.7 million. So on an overall basis, what we like to look at is to make sure that, one, there's cash and investments to be able to cover all of the reserves that the town has put away, which would be all the internally restricted reserves, the 46 million that are there. We also like to make sure that you have enough cash to cover the deferred revenue, because it's an important thing that is other people's money. So we want to make sure you can cover what you've put away for yourself and what you're putting away for others, and you can absolutely do that. So your ability to cover that has increased this year, and the financial position of the town has improved and still very healthy. Healthy.
It's nice when you say that.
Yes. So on an overall basis, those are the statements on the quick overview of them. Questions?
Just to characterize in sort of lay terms what you just said. So how I translated or repeat it, is, I mean, if you think of it as a simpler operation, if we had to cash in, I mean, if we had to liquidate, if we sold all of our financial assets or cashed in on all that and paid out all of our current existing debt,
Yes,
we would still have
19 million left
a
over. Plus the value of any tangible capital
Right.
assets, your buildings and everything
Yeah.
else.
So that clearly speaks to, and I'm thinking along the lines of how we use debt, and it clearly, I think, shows that the debt is very manageable. The debt that we're using to finance projects is manageable for those reasons.
Yes, absolutely. You're not, and we'll review that, well, subsequently in the financial indicators to look at your debt, but yes.
One question from the statement of financial position, the fourth line down under financial assets, the investment in future housing developments, note 5.
Yes.
Note 5 provides some information, but the number beside note 5 is 1.6 million.
Correct.
But
So the number
not-
in note 5 would say the total cost expected for the project. The actual number that is sitting on the statement of financial position would be the land acquisition and the development costs that had been incurred up to December 31st. And that's on the old daycare land,
Okay.
which now has a new name, I believe.
Hawks Bend. So the 1.6 reflected on the, under financial assets, that's specifically in regards to the land and the development costs.
Correct. On that side, instead of being in work in progress, any of the new land developments are held as an investment in the developments until they're completed, and then they're moved to tangible capital assets. Any other questions?
Yeah, I'm getting to one here. Trying to understand my notes to self. So the deferred revenue in note 8, so that's 31.4 million deferred revenue. So is that included within the what's described in note 2, cash and temporary investments, and note 6, the other investments?
Generally, the note, anything sitting in deferred revenue would probably be included in the investments in note 6, more of long-term investments. There'd be a mix between the long-term investments and cash and temporary. So the cash and temporary investments, temporary usually anything with a maturity of 3 months or less, and then anything over 3 months would be in the investment, long-term investments. So there'd be, all of the deferred revenue bit would be in one of those two avenues.
Great, thank you. And are you looking then for questions just on those sheets or on the notes?
Any
old question.
Any place you want.
Okay. Councillor Sanford.
Thank you, Your Worship. Thank you for your presentation. When, in note number 13, there's a number of the restricted surplus and the unrestricted surplus.
Yes.
So the unrestricted surplus, is that available to us for any purpose that we could possibly want?
Correct.
But the restricted surpluses are included in all
You have
those?
previously put those, earmarked them for other specific operating or capital purposes, yes.
Right, so they're already in reserves that we've earmarked.
Yes.
But we could actually move money around between those reserves. Is that
Yes.
correct?
With
if we
council
had-
motion, yeah.
So, but the unrestricted is what isn't allocated to any particular reserve?
Yes.
Okay. So,
Which there will be a motion to move some of that into a reserve.
Oh,
subsequent
okay.
to This presentation.
so that's part of, right, that was you said there were 6 million, but the actual
Yeah,
is
so there'll
2.7?
be essentially 2.7 million, I think,
Okay.
2.7 that will be, you'll have a motion for soon, or a proposed motion to move a portion of that.
So that just characterizes the surplus from 2017?
Not all of 17. So if you'll see the 5.1, the surplus for the consolidated statements would have been the difference between the 5.1 and the 6.7, and that would be the amount that was not pushed into reserves at any point in time.
Okay. So we will deal with that 666.
Absolutely. And we'll have a reconciliation that brings these financial statements into exactly what your surplus is and what's being transferred.
Okay. Can we just go back to that appropriation for the Waste Management Commission that you mentioned, that we talked about?
Note 19.
Is that the correct way to characterize that? Because it's actually a debt that's being repaid to the Waste Management Commission?
If it is a debt, then we should be showing it as a debt as opposed to an appropriation.
Well, because it's a bulk of money that was advanced to the town, which is now repaying to the commission. So it's actually not a requisition or an appropriation, it's a repayment.
Of debt.
Yeah.
We can absolutely change
So
the
I don't
word
know, does
appropriation.
that affect our,
I think the CAO has a comment. She certainly looks puzzled.
Yes, I'm looking puzzled, but I haven't looked at the Bow Valley Waste Management Commission statements recently, but my history with the commission was that it was, the commission received grants to build infrastructure. The grants were provided to the town of Canmore to build the infrastructure, and then as a condition of the grant, we have to put funds, we pay the commission appropriates from us funds to ensure that there's a reserve to replace that asset in the future when we are to rebuild it. So I guess I wouldn't characterize it as debt. We're putting funds that the commission is required to hold in reserve so that there's funds to replace that asset in the future.
yeah, so that was the condition of the WMAP grant.
Right.
Is the commission could lend that money out to its member municipalities, and then there's a repayment schedule for that.
But it's not repaying the commission. The commission is required to hold those funds in reserve so that when the asset is at the end of its life, there are funds to replace that asset.
Or any other regional asset.
Yeah. So, I mean, perhaps I look to Mr. Scott then, whether that's debt or
And we wouldn't have the debt. The debt is not currently set up on the book, so we'd have a bigger issue than just showing this, because we'd have to have the associated debt actually recorded as well. So we'd be missing a larger
That would
portion of
require
that.
some kind of a loan agreement, wouldn't it?
Yes.
Yeah, and there is one, and that's why it's $84,500 for however many years that debt is repaid. So it was about a lump sum that was advanced, and then it's being repaid into a reserve to again fund. It's sort of a revolving financial opportunity for the member municipalities, because it's going into a reserve that the commission controls. I guess it's just because the commission is self-supporting at this time, but so what the town is actually doing is repaying money that was advanced from the commission. So,
Well, there's clearly some
the grant.
work that's required to understand that. I've never understood it that way, but.
yeah.
So in working with the commission and the town of Banff in regards to operating agreements in the past little bit, we did look at the purpose of that money that's going into the commission. And at that time, my understanding of the documents was that was a grant, not a loan. And the idea of the grant was to be self-sustaining so that we wouldn't have to keep coming back to the provincial government to get money for these assets. However, that said, I don't think it makes a material difference to change these statements today. What I'm proposing is that over this year, we take a closer look just to ascertain, to confirm or to correct the interpretation of that agreement and the purposes for those funds, whether it's a loan repayment or whether it's a contribution to a reserve held by the commission. We can certainly look into that and report back to council during the year.
Yeah.
Okay.
So just in that correction that you had, it was 84,500.
Yeah.
So that's the actual value that's
Yeah.
going back to repay that amount of money that was put out to build the waste transfer station, et
That's
cetera.
the amount of money that's being transferred to the commission.
Right, yeah. And the commission's holding it,
Yes.
and it's available to member municipalities to re-access at some point, so,
Well, we'll clear that up this year.
great, thanks.
I have a question related to note 6, investments. So we added almost $20 million in this year to investments.
Correct.
So where would that 20 million have come from?
A lot from the surplus we went through. So on the cash side, the deferred revenue, so a lot of it's going to be the unspent grants that came in, as well as the additional $5 million.
So that would
revenues.
include things like the FREC grant that we just
Absolutely.
mentioned. So that makes sense. Thank you. And one other question. I hesitate to go here, but I had some conversation when we were going through this as a draft agenda. I'm still trying to understand how the CCHC debt is calculated within the towns. So on note 10 at the very bottom, it notes the debt limit calculation includes only the town.
Correct.
And is that as opposed to what?
As opposed to including all of the total debt and debt servicing from, and revenue from CCHC as well.
Right.
So this will be the same note as you would see in the non-consolidated. So this gives you a better picture of what just the town.
Right. Okay. I might come back to this in another point. Yes.
Would you like me to sort of explain?
Yeah,
that?
just sort of ramble on a bit about it.
Okay, I can do that. Mom. No, yeah. Okay, so in the province of Alberta, there's a regulation called the debt regulation, and it dictates what municipalities can and cannot do and how they need to report or not report on various debts. And it also sets the parameters to help the provincial government provide a framework to ensure municipalities don't overextend themselves with debt so that they become non-sustainable and the province has to step in. So that's the purpose of the debt regulation. When you look at the debt regulation, it tells you how you're supposed to calculate your debt limit and how you're supposed to calculate your debt service limit. But there's a choice. So subsection 6.1 says a municipality can choose to include the revenue, the debt limit, and the debt servicing costs of its controlled corporations when it's calculating its debt and debt servicing limits. It can choose to add them in. Choice. Town of Canmore has chosen not to include those in our calculations, and there's lots of different philosophies. We look at CCHC as hopefully looking after themselves. They're run by a board that's overseen by council, but they operate separately, and it made sense at the time to make the decision not to include them in our calculations for our debt. They take care of the housing stuff, then that gives us an idea what's left for the rest of council's initiatives. So we actually brought that decision to council. So council in the past has made that decision and said, yes, we agree. Don't choose to calculate our debt limits with CCHC included, and our auditors are fine with that. Different municipalities choose differently. Town of Banff is one of those who is chosen differently. They choose to include their housing authority's revenue, debt servicing, and debt limit in there for their calculations. Is that enough rambling?
Pretty much. So just, that's how I understand it, because we've had very recent conversations about this. Then what puzzles me, though, is on the consolidated statement of operations, the CCHC rental revenue is reflected.
Yeah, so the only thing we get to choose to exclude CCHC from is the calculation in that note. So if you're preparing financial statements on a consolidated basis, the financial statements themselves have to include those ones that Mr. Scott had mentioned, CCHC, the BRZ, and the library. So that's the purpose of consolidated financial statements. That's why we also prepare non-consolidated, so to just give a snapshot of the town not including that.
So for the purpose of these earlier statements, you have to include,
Yes.
and for the purposes of other documents, you
The
don't
debt
have.
calculation, so simply that note,
Just what's detailed on note 10.
yeah. Then
Okay.
that's the only place we can exclude them.
Okay. I don't understand why, but that's fine.
Because we get to choose.
No, I understand that.
We're exercising our adult right to choose.
Okay, thank you.
We always recommend with the debt limit that you would normalize the revenues as well, because the debt limit is based simply off of 1.5 times operating revenues. There's insurance proceeds, there's a bunch of things such as development levies that you don't know if those are coming in regularly, that you shouldn't be planning for those on an annual basis necessarily at the levels you have. So we always suggest normalizing your revenue to calculate your own debt limit essentially before actually going out and borrowing.
Okay, thank you. A similar question under note 8, deferred revenue. I also asked this at the agenda review. It's more for the sake of asking it in the public meeting. So the Friends of the Library, it reflects $8,633 in our deferred revenue, towns.
And that is deferred revenue which is included on the library statements, and so on a consolidated basis, theirs
Okay.
joins with yours.
So that's revenue that the library expects or
No,
has
that
in
is-
hand?
That is revenue that the library has in hand that they have yet to spend.
I see. So it shows up on their books, and for the reason we just detailed, that has to show up on our books.
Correct.
Thank you.
Can I ask another question, Your Worship?
Absolutely.
I know I'm probably not showing up on your screen because I was the last speaker, and then I was
Yeah, there you
pressed
go.
it again. So,
Yeah, you know all my secrets.
I just had a question for you about number 16, note number 16. And under other expenses, the budget was $87,308, and under the actual is $2,658,000. Do we know what something got moved around there? Expenses by object. I'm not really sure what that means.
So part of that is going to be the other environmental use and protection, which is not budgeted for and had $942,000 included with it. The other portion would be a lot of, I'm going to say, non-capital TCA expenditures. So generally, the municipality would budget for tangible capital assets, and those are going to be funded by capital revenues. If they do not meet the qualifications of tangible capital assets, so the project occurs, it doesn't meet the threshold, or the project is deemed not to have future life or increase the life of a current asset, it gets moved as an operating expense into the income statement. So it's essentially capital funded, capital type projects that don't meet the capitalization threshold. Those get moved in here, and those are not budgeted for. And there's about another 1.5 million of those as well. And that balance, the actual balance of that will be included on the bridge when Rick runs through that as well.
They're not budgeted for in the operating budget, but they're budgeted for in the capital budget.
On the capital sheets,
Yeah.
those, yeah, okay. So it's just the way we're reporting it here in this section?
Yes,
That-
yes.
Okay.
And there's no other real place to put it.
Hmm.
It's a lot of essentially repairs and maintenance.
Okay.
That's all your questions at this
I
time?
think that was all for now, thanks.
I think that's all the questions I have specific to the consolidated financial statements. Attachment 2, is that attachment 2 to this report? I think it is. The indicators of financial condition. Is that something you're going to go into later, or
I can do that right now for you if there's no other questions on the financial statements.
unless there's other questions from members of the Finance Committee? Councillor Sanford?
And note number 19, we have a list of all the different agencies that we advance money to. But we have more affiliates than that. So do there, like we have the Biosphere Institute, and there's a number of other affiliates that aren't captured in here? Are they in another place?
Not as far as the documented balances between the two. Generally, what we're going to have in here is called government-controlled entities. So if you have council members that are on there and have more control over it, that is what gets consolidated. The rest of them would be any amounts that were material for disclosure. There are probably smaller, I don't know what the smaller ones would be.
Yeah, like victim services and I guess Biosphere. I'm just thinking of the affiliate list that we get at the end of the year during budget.
Yeah, so this list isn't affiliates. It's related parties. So you have to look
Okay.
at the structure and the governance structure, which is what Mr. Scott was alluding to.
Okay.
So if council has a governance component, then that would be considered to be a related party and it would be on the list. But not all of our affiliates do we have a seat on the board, so to speak, so they wouldn't be considered related parties. They would be funded parties, but not related.
Okay, so that's why they're not there.
That's correct.
Different relationship. Okay.
Just to that point, the Biosphere does have, as part of its bylaws, the mayor's appointed to the Biosphere board.
Just the mayor. Are you there's no other members of council?
No.
Yeah, so there has to be a controlling amount or a significant influence on that board. So it depends on how many council members are on there, and it also depends on how many people are on that board. So there's a specific list that we run through and go through all the related and affiliated parties to determine whether they should be disclosed or not.
Thank you. If there are no further questions, we could move into discussion, presentation and discussion of the indicators of financial condition, which I find a really interesting report.
Yes, so these are, a regular question we were asked from council was, how do we compare to other towns, other municipalities? So we decided to create financial indicators for council to be able to answer that question.
Is this the third year you presented this report?
I believe so, yes. And there is now something coming from Alberta Municipal Affairs, which is municipal indicators. They have created their own, many of which are included in here.
You
on
probably just looked at ours and copied it.
Yeah, exactly. They have added some different ones, however. So there's 13 indicators, new indicators that will be coming out. I believe it starts next year. If there are any issues for your municipality, they will let you know ahead of time. All of the results will be public. Every municipality will need to have to hit 11 out of 13 of those new indicators. And some of those are, do you have a clean audit opinion? Has municipal affairs ever had to step into your community? Population change, other financial indicators come through as well. So we will adjust our report to include as many of those as possible so that you have a heads up much earlier than they will give you in the future. This report we went through, just so you know what the comparables are. So on a comparable basis, we compare the town of Canmore to, one is going to be all towns, any municipality with the designation town in Alberta. So that's going to be the red line on this report. The comparable town average is going to be towns that are either 25% larger or smaller in population comparison. And the purple line is going to be comparable municipalities. So that could be counties and MDs that have populations the same as you, just to give another comparative range for you for the purposes of identifying where you would like to be and where you are at. Any questions on those comparables?
Yeah, so looking, the red line, the town average, is that the first list?
That is not, those are not listed because that is anybody with a town that is a town.
That's what you said at the beginning, though. So
Yeah.
anybody's a town,
Correct.
regardless of the population or anything else.
Yes. So the town of Granham's included in that, and they have 313 people. So it's a significant difference. They'll bring down those stats. However, they're included.
And then the comparable town average,
So the comparable town average is going to be the listing on the left. Your municipality is always included in the average because it's sitting in there.
So that's the short list on
yes,
there.
6 or
Those are
7
comparable
municipalities.
town. And then the comparable population is the second list.
Correct.
Thank you.
So when we get into the numbers, a lot of these are ratios we like to look at when preparing the financial statements. First of which is assets to liabilities. So this is everything the town owns versus what the town owes. So the total assets for the town are nearing 400 million, and the total liabilities were 70 million. So this, with a large increase in deferred revenue, up to $30 million, it increases your liability side, having all of that revenue come in, although it increases the tangible capital asset, or the cash side as well. It's not significant change on the above, so that's why you'll see a decrease in this year compared to last year because of a lot of deferred revenue, which is money owed to others coming in on this. When we take out the tangible capital asset side of it, you can see that that money coming in offsets against the cash below on the financial assets to liability. And you're in a relatively average position. You're at 1.28%, which is right among the comparable averages for all towns and comparable sized towns. So you're right in the range you would want to be if you're looking to be average. You're not holding excessive amount of funds. You don't have an excessive amount of liability. You're right there with everybody else.
Average in that indicator is fine, but in every other way, we're far above average.
Yes, yes. Which we can note. So the next indicator is operating expenses to taxable assessment. So as a town, you have a healthy taxable assessment, and you manage to keep your operating expenses low in comparison. So in comparison to all other towns and other similar type municipalities, down at 74%, having your operating expenses that low is that's the right place to be. You want to be low on this scale, and you're very low in comparison. So operating thin.
So we're doing really well in managing our operating expenses.
Absolutely.
Which includes staffing and all.
And this also includes amortization as well. So there's $8 million of amortization in there.
So we're doing really well.
Yes.
Okay, really
yes.
well.
Really, really well.
Okay.
On the public debt charges to revenue, this is going to be your debt servicing compared to your operating revenue. Once again, very average. There was a time where this was very high. The town has got the debt down and increased revenues, which has brought you right back down to the average of everybody else. The problem in the past wasn't a little bit high in the debt as a town, but the revenues were far below what there was to sustain the amount of debt in comparison to everyone else. But right now, you're average, and that's a great place to be on this indicator for sure. The next is going to be net book value to cost of tangible assets. So this will give you an indication of the age of your assets. The new indicators that are coming out, this will be one of those indicators, and there will be a baseline. So 40% is going to be lowest. So if the net book value drops below 40%, all of your assets have less than half of their useful life left, and that's going to be a problem for a municipality should they be below 40. You can see that most are not there. You're at the high end of this. New housing definitely helps that, and a lot of flood recovery projects have really increased the cost of that assets, or the assets. The town has done a lot of capital projects, which have really bumped up that value over the last 5 years. So it's a nice thing to have all of your assets being at 75% of their useful life, so everything is fairly new here in comparison to the majority of municipalities. It's one good thing about having floods is you get a lot of new infrastructure. It's probably the only thing that comes with it. The own source revenues to taxable assessment. So this is going to be low in comparison. So this is mainly driven by the high taxable assessment that you have as a town. It brings you below. In comparison to most towns, the taxable assessment is a lot higher. And the last would be government transfers to total revenue. So this is
just on that last one.
Yep.
The own source revenues to taxable assessment.
Correct. So this is own source, which excludes any government transfers for operating and for capital. So this would include any other revenues, essentially everything other than government transfers. Development levies, rental, insurance proceeds, user fees.
I see. But not tax revenue, but everything else, all of our other revenue.
And tax revenue is included as well.
And tax revenue.
Yes.
Okay. Great, thanks.
The last indicator being government transfers to total revenue. So this is the opposite, essentially, all of the government revenue that comes in as a percentage of total revenue. 13%, which is below all of the comparables. So the amount of government revenue you had in comparison to all of the municipalities is lower by about 2%. So that can depend on what projects are happening. At the end of the year, your town received, there's still 31 million in deferred revenue. So had those projects started and some of that revenue been recognized, this amount would have gone up. So this ratio is very dependent on what capital projects you're doing from year to year.
So that ratio doesn't include the deferred revenue?
No, it does not. It only includes what was recognized during the year. So highly dependent on projects.
Do you want to speak?
I got good hearing, you're all right.
Everybody at home couldn't.
That's true. That's true. So that is your report as far as your comparisons to other municipalities. And this is simply just to give you an idea of how you do in comparison financially. I'm not saying any one of these are good or bad or where you want to be. It all depends. It will help you assess your future plans as far as moving forward. Maybe you're spending too much on capital and want to bring that down. Not suggesting that whatsoever, but just things to think about. This lets you know where everybody else is, and maybe you want to move that line one way or the other.
Well, you know, it's a helpful tool to have in the toolkit. From time to time, there are those in the committee will suggest that we're performing poorly on financial matters compared to everybody else. It's like, well, no, that's not true. But now, you know, with these kind of reports and a lot of other data that we gather through this process and related processes, it's easy to just simply point to the data and say, well, in fact, no, we're performing quite well compared
Absolutely.
to all those other communities. I did that once with a resident having to do with our debt limit or something. So I shared with her the data.
Yep.
Her response was, well, so you say.
No, these are so the provincial
no,
numbers
say. No, that's not what I
actually.
say. These are, anyways.
And it does show that you're not excessive in certain ratios, like assets to liabilities. So it's not that the municipality is hoarding cash and sitting on it and not doing anything with it. You're at the same level as everybody else, according to this.
Yeah. So I had a sort of a general question that I wasn't too sure where to plug it in, but right here it seems appropriate given what we've just been talking about. So how would you characterize the town of Canmore's use of debt financing, our approach to using debt? How would you characterize that?
Well, according to this, you're good. you're in an average position. You're not over leveraged by any means. There's still a lot of room within your debt limit for future debt, should you wish to incur it, or should you need to incur it. I don't think anyone is wishing to incur it by any means. I think it's well managed. There are municipalities, you have the benefit of having a large enough municipality to have access to debt. There's many smaller municipalities who simply can't do the projects they wish to do because they can't access the debt. A lot of water projects need to be done. Commissions don't have the revenues. They have to do joint initiatives to be able to get those revenues to do a water treatment plant, per se, even though a commission would have a 2.5 debt limit as opposed to 1.5. So you're in a healthy position. You can access the debt that you need at any point in time.
Thank you. Councillor Comfort.
Yeah, to that, I think there's a note in the charts where you mentioned something about flexibility that we have, because of the room in our debt limit, we have flexibility if something, an opportunity comes along, or God forbid, a liability, we have the capacity to deal with it.
Yes.
Okay.
And you've shown that you've proven you were at 14% before with debt to operating revenue, debt servicing to operating revenue, and you brought that down to 6%.
Yeah.
I mean, it was a temporary thing. Revenues increased to cover that off, obviously, but the debt has been repaid, and you're back into that that level the same as everybody else for the most part.
Yeah, and to that, having the span of, I guess it's 4 years, 5 years?
4-year comparative and 5-year of your own, yeah.
Yeah, so we can see that the ebbs and flows based on whatever else is going on, and the notes can speak to that.
Absolutely.
Yeah. Okay, thanks.
Are there any other questions or comments regarding the financial indicators? Did you want to talk at all about the attachment 3, the letters?
That's for in camera.
Pardon me?
I believe the letters are in camera.
So those part will wait for in camera?
Yes.
Okay. In that case, I will now move that the Finance Committee go in camera for a verbal interview with the auditor.
Nice.
Those in favor? Opposed? Will be in camera. Town of Canmore's consolidated financial statements for the year ended December 31st, 2017, with a change to note 19 as detailed. Discussion on the motion? Seeing none, I'll call the question. Those in favor? Opposed? Motion's carried unanimously. Just before moving on, I will thank Mr. Scott and Avail LLP for the work you're doing and the open attitude and the really solid sense that you provide counsel on the work we're doing in finance and in the healthy financial situation the town's in. I know that, but it's really encouraging and important that we hear that from an unbiased outside independent auditor. So thanks for the work you and your firm do and continue to do for us. And with that, then I will move on to item D2, 2017 Administrative Financial Report.
Okay, so now comes the part with hopefully numbers that make more sense. So this administrative final report, there's three purposes behind the report. The first purpose is to present to you the operating results for 2017, done on the basis in the same way that we do our budgeting. The second purpose is to report to you on the capital results for the year. For all of the capital projects that we were worked on during 2017, there's a report. And then the third purpose of this report is for the Finance Committee to decide how you want to, where you want to send our surplus funds to. Traditionally, hopefully, not anything other than to reserves. So our recommendation will be a series of reserves. So that's the purpose of this report. So the operating results, basically we start out with what administration has calculated, and that's based on our fund accounting methodology, the way we do our budgets, as a surplus of 2.7. And then what we do, the next numbers tie and do the corrections in order to get you to first a non-consolidated surplus number, and then at the bottom, the consolidated financial statement surplus number, which is the number that Mr. Scott had been talking to you earlier today. There are a number of things, and Mr. Scott did mention this, transfers to and from reserves, capital revenue, deferred revenue, debenture, principals, all of those types of things are accounted for in the financial statements that have to be prepared in accordance with the public sector accounting body. That's not the same way that we prepare our statements. We prepare them in a way to show council that we are fully funding the things that we do. So I won't go into a bunch of detail because that was in your package, but that just sort of ties in the financial statement you were just looking at to the 2.7 that we're now going to start to discuss.
Thank you.
Thank you for not going into detail, or thank you.
Well, you know, we talked a bit about this as gender review, and it's quite clear in attachment 1 how you can follow the breadcrumbs back to the consolidated audited statement number.
Yeah, and we just took a conglomerate number for the entities that are consolidated with us. When it's time for budgets, part of the affiliates presentation, the package that we bring to the Finance Committee includes their financial statements. So at that time, you would have copies of the financial statements that all go in and were amalgamated with ours. So the operating surplus, there's reasons why we had an operating surplus. Part of it's revenue reasons, and the other part is expenditure reasons. So first, I would like to talk to you about the revenue reasons. So revenue was $1.4 million to the better than what we had anticipated it would be. Almost 900,000 of that is from planning revenue that exceeded what we thought it was going to be. which isn't a surprise to anyone as it was a very busy year. And all of these things we have been reporting on. Mr. Irwin reports them when he talks about the variance analysis reports that comes to Finance Committee. And none of these are a surprise. We have been reporting to the committee on these throughout the year. There's $205,000 more franchise fees than we thought, $163,000 in investment revenue, $159,000 in non-utility offsite levies, so transportation projects. And again, with increased development comes increased offsite levies. The utility offsite levies go into the utility department, and that's a net zero department, so it doesn't feed into the surplus, and that's why I specified that $159,000 better didn't include utility offsite levies. We had a $58,000 WCB, or Workers' Compensation Board rebate. And then off of that, we had some revenue lines that were important to note that didn't come in as high as what we had budgeted for. And again, these things we did report on during the year. So it's about $120,000 less in policing fine revenue. We had recreation revenue was trending lower than what was budgeted for, as well as cemetery revenue had decreased. So all of those ins and outs and all abouts takes us to a net of $1.4 million in revenue to the better. So, expenditure side. So expenses came in under budget by just over $1.2 million. So what are the reasons for that? You know, it's amazing when you sit down and you look at all the different accounts, you know, and it's kind of like, you know, that saying where your mom said, look after the pennies and the dollars will look after themselves. Well, it's kind of like there's a little bit here and a little bit there and a little bit, and before you know it, it all kind of adds up. So that's sort of the part of it. The all others was, you know, significant amount of money, but it all comes from different places. So I started out with the ones we can kind of pick out, which is contracted and professional services. So that was $647,000. Part of that comes from, I know that there's contracted and professional services from planning. So that $253,000 less was spent than anticipated. Policing was the policing contract came in $273,000 less than we thought it was going to. And then all the others, all those little pennies added together are $121,000 coming from all the different departments under contracted and professional services. Then we move into $421,000 of that $1.2 million is just basic general savings in many, many different lines. Again, trying to pick out the bigger ones. Education, training, and conferences, $115,000 less than what we anticipated. Supplies were $103,000 less. Telecommunications, mostly cell phones, were $41,000 less. And every other, all the little pennies again, were $162,000 to the better. Tied into the education, training, and conferences, a bit of it ties also into the next savings, which was the slippage. So slippage includes positions that remain vacant during the year, but also people come in at different compensation rates than the incumbent was there before. But a lot of it is empty positions, and when you have empty positions, it makes it really hard to send people for conferences and training and education. One, because everyone else is picking up the load, and two, the person maybe you decided you plan to send no longer works here, and so you don't send anybody. So many different reasons for all of these things, but that kind of all added together brings $1.2 million. If you would like more detail as to each department, what their specific ins and outs and overs and unders were all about, you can find that in attachment number 2. And that breaks it down by department. So I'm not going to go into each department, but if you have any questions when we get to that time, I'd be happy to answer them. So that's the first purpose. Do you want to pause here?
Councillor Comfort?
Mm-hmm. Yeah, just out of curiosity, the savings in telecommunications of $41,000,
yeah,
that's not insubstantial. Did we sign up with a new provider? Did we improve our practice? Like, that seems like a fair whack of money.
Yeah, so if I'm remembering correctly, because you make an estimate and try and figure out how much that's going to come in at, and we also try and find ways to save. So I know that what Mr. Wingenbach our IT supervisor, had said that they were able to get into a plan that allows us to pool our data. So rather than the data being for each phone, it's a pool, which I think has manifested into some savings here.
Okay, thanks.
So just a question regarding the reduced contract costs for the RCMP. There's some detailed on the roll-up, page 60 of 172. So it notes lower overall contract expenses combined with cost of RCMP radios and a reversal of prior year accrual for officer contract settlement. Are you able to help me understand what that means?
I'm going to ask Dr. Cottle.
So basically with the RCMP, there's always a timing thing. Their year end and our year end are different. So we're always estimating and guessing what the expense will be, and then we ultimately receive actuals. So this is always just a bit of a leapfrog and a guessing game. And that's really all that that's referring to, is the timing of our having to estimate what the cost will be for radios and for staffing, and then the actuals, the difference then were the actuals that come in.
So in budgeting for staffing, we generally work with the number of staff. I mean, we know how many RCMP staff are on the contract, right?
Correct.
And then we essentially use that same number, unless there's a request for increased staffing there. But then the way that's invoiced is not certain?
There's timing there around the invoicing and what their costs are, because they give us a budget and a bill rate annually, so their costs increase. But also, RCMP officers frequently move, and so while we have a certain number, we may not increase the number of officers. One may be transferred, and then there's a delay until we get the next one. And so just like our own staffing costs, we see fluctuations.
Yeah.
That also happens with the RCMP.
That helps me understand. It's just, I mean, that number's quite a large number, 273. And it's only in light of the fact that we're going to be talking in a few minutes about preparing for what we know to be coming increase in staffing. So want to understand why we're $270,000 over budgeted on that expense.
In part, I believe some of what happened last year, also, although I don't know the specifics here, it was around, you may recall, at budget time, we were talking about radios and a change to radios that would work with the RCMP system. So over time, we were phasing in those radios with the RCMP. So some of that difference may be with those radio costs. I don't know specifically. I think, correct me if I'm wrong, Ms. Van Kuypema, this is a significantly higher number than what we usually see with RCMP surplus. So I don't think it's a pattern. It's more of an anomaly.
So it's not something that there's going to suddenly be another invoice for. I mean, that net savings of 273 is certain for 2017.
Do you want? Looks like
Mr.
Mr.
Irwin
Irwin wants to add something.
Add away.
I can clarify a little bit. The true contract savings was about $127,000.
Okay.
As Sally said, with staffing changes and all that kind of stuff.
And that's about the equivalent of one officer, is that right?
Approximately.
Yeah, okay.
Approximately. In the last 2 years, the RCMP have been going through contract negotiations and settlements, and we've been accruing the last couple of years. They've been giving us amounts to accrue for their settlement. Well, they have settled, and we reversed our last year's accrual, so that's approximately $145,000.
Okay.
That makes up half of that 273, which won't happen again. Or, you know, and then that partially is offset by 40 grand in the radios. So that's how it's all netted in.
Great, thank you.
Thank you.
Okay.
Yeah.
Shall I carry on to the second purpose?
Yes.
Okay. All right, so the next purpose of this is to provide you with the results of all the capital projects that were worked on during the year. So the details are in attachment number 3 in your report. And again, I'm not going to go into the report and go through all the details. Just to let you know, attachment 3 lists all your projects that were budgeted for in 2017, so that includes previous year's WIPT projects, as well as 2017 budgeted projects. It provides you the actual amount of money spent in 2017 on those projects, the amount that was budgeted. There's a column that tells you what's been spent totally, if it's projects that have come over from other years. It gives you the funding source, as well as the status of the project, whether it's been completed, whether it's carried forward, and that would be a WIP, or whether it was canceled. Or sometimes, as you know, council will get requests from managers to amalgamate capital projects, so there are some that have been amalgamated with other capital projects. It also provides you, there's also part of that report is to give you sort of what we call a continuity schedule of the reserves, showing you the ins and outs. So we start with the opening balance of reserves, what went in, what came out, and what the ending balances were, and the same thing with the deferred revenue. So when Mr. Scott was presenting, he gave you a list of deferred revenue. This gives you a little bit more detail on how those numbers changed, what went in and what came out of those numbers. There will be chance for questions, but is there anything on purpose 2 you'd like to ask right now?
On the capital project closeout?
No, not yet. Just on that report to let you know. We feel it's important when we're providing you with the financial statements, because your capital budgets are a significant part of the money that's spent in the town of Canmore. And so I think it's just as important to provide you with financial statements and how the operating surplus came to be, but also to give you a report on how how the money for those projects was spent. Okay, then I will move on to the third purpose. And the third purpose is what are we going to do with our surplus from 2017? So first, a little bit of history is provided in your package to give you an idea of what previous councils and finance committees have chosen to do with the surpluses in each year. In 2016, there was no allocation to the PAH, or Perpetual Affordable Housing Reserve. As we knew we'd be selling the lands on Palliser Trail to Northview REIT for development, and there'd be funds from that land sale. So it was felt that there would be money going into the PAH, so the decision was made not to also put more in there in 2016. The flood mitigation structure maintenance reserve and the asset rehabilitation and replacement reserves, those were relatively new reserves, so we decided to take some money and give them a little boost, especially because we had cut some of the reserve contribution increases in the budgets for 2017. So that gives you an idea what has been done in the past, not that you have to follow what's been done in the past, but gives you an idea of some history. So what about the present?
Pardon me?
You looked like you had a question.
No, I didn't. I'm trying to keep up with you here.
Okay, I'll slow down. So that was the past. Moving on. So what are we dealing with today? So today, administration is making a recommendation to allocate the $2.7 million surplus to 4 different reserves, and there is method to my madness, and I will explain that. So the reasons, dealing with how did I come up with $458,000 for the general operating? So also in your package, in previous direction, is a list of resolutions that council has passed directing a total of $458,000 be increased, the 2018 budget increased by that amount to be funded from the general operating reserve. So with the idea at the time that we probably would have a surplus and that we could put the surplus in to help fund that 2018 budget increase. So that's how I came up with $458,000. Tax stabilization. So I start thinking about the police contract, and you could calculate it many different ways. You could say just what the staffing difference was of 120 that Mr. Irwin mentioned, or you could take off the 120 in policing fine revenue that was lower than we thought. So there's all different ways to calculate it. So I just went with $273,000 is what the difference was in contracted services. And my recommendation is that at our last census, our population was just under 14,000 people, permanent population. When we hit the 15,000 mark, our responsibilities for paying for the policing costs will increase from 70% of the cost to 90% of the cost. And with our trends, we're anticipating that we will hit that $15,000, or $15,000, huh? Boy, if only it was so cheap, 15,000 population number at the next federal census. And so, being prudent, we are planning to not just all of a sudden in the year that we go from 70 to 90 to go poof, big tax increase. We're coming up with a way to think about how is it we can smooth that in so that it's a gradual tax increase, so that it's not such a big hit all in one year. And it's as an opportunity, it's a one-time revenue that we not necessarily going to see again. So it's an opportunity to put some of that money away, and that money can sort of kickstart the smoothing that we're going to do. So instead of a bunch of tax increases, so we get the whole amount when we're ready to go, we can smooth it up, we'll have some money in the reserve, and then we can smooth it down on the other side. So we could implement, say, over a 10-year period, or an 8-year period, whereas maybe you might have only done it over a 4-year period. So that money will help us do that smoothing, and that smoothing would be a decision of council during budget time. That's when, or the finance committee, when we would be talking about how are we strategically going to work it so that we have the funding available to meet our policing increased costs. So that's how the recommendation for the tax stabilization works. Normally, I'm a person who says tax stabilization is a one-time funding source, and if you have an ongoing expenditure, please do not use a finite funding source. But in this case, it makes sense because we do have a plan to build it up and then wean ourselves back off of it.
Remind me what the weaning ourselves off of it part looks like.
So I did look at when is the last time we used the tax stabilization reserve, and we did.
A long time ago.
Well, not so long ago, let me tell you.
Oh, yeah?
I had to deal with the weaning part. I did. So when I came in, we had used it, I believe, the year before. Yes, 2013. So 2013, the tax stabilization was used to lower the tax increase. And then that meant in 14 and 15, we actually had to budget a tax increase because otherwise we would have had to take more money out of the tax stabilization reserve to offset that decrease in revenue. That revenue source we no longer had, so we had to increase taxes. So we weaned ourselves off over a couple of years. I have more details if you want to know why.
No, that's okay.
Okay.
I do know too.
Yeah. So, and that was pre-flood. That was decided at this time in 2013. Okay. So moving on.
I think it's an interesting line of discussion, anticipating that the known increase in policing costs, and coincidentally, because there is that savings associated with the policing services now, there's a really direct cause and effect sort of a link, which I think makes sense. But I was struggling with what we've learned over the years about not using that tax stabilization reserve for things that will be recurring. So that was the part that, you know, I have to give a lot of thought to, but what you're saying is helping with that?
Yeah, so it's going to be used as a repository of the funds that we're going to collect before we need to spend them, so that we can smooth that over, and then when we're starting to spend them, we can use that to help fund a part of it, so we won't have to have a big tax increase in the year that we have to start spending. So I think that that's a prudent use of the tax stabilization. It is a repository with a plan of how the funds are going to be collected and how the funds are going to be expended, and that there is a sort of an end that's defined before going in.
Yeah. And if I recall, that was one of the principles through which council established that reserve, is having a buffer for future need. Councillor Comfort?
Yes, thank you. I have a question about, are there any other known consequences to arriving at the city status that are as concrete as the RCMP expense? Are there other things that we know that are directly tied to are rising to that level of,
I don't know, but I'm really hoping someone over here does.
yeah, all those big brains over there.
We are officially a city population currently. So the city population threshold is 10,000. The 15,000 is a policing population threshold.
Condition.
So no, none to my knowledge that we have any other.
Okay, I just wondered if there's anything else to flag. So is there another threshold, say at 20,000?
No, at some point in time, we could consider whether or not we want to provide our own policing service. So cities get large enough that they bring policing in-house and deliver that service. The smallest municipality in Alberta that I know that's doing that is Taber.
Taber, yeah. Okay, thanks.
Okay, so the next recommendation is to transfer $644,050 to the PAH reserve. And you'd think, where did that come from? That's a pretty specific number. So where it comes from is traditionally, or before we made some changes to the reserve contributions, targets, and that information on the schedule that's attached to our reserve policy. One of the things is that the PAH can get filled from planning revenues, or planning surpluses, pardon me. So, given that, the problem is how do you calculate, what is a planning surplus? The planning department is a loss department, meaning when we budget that they will spend more money than they will bring in. So your surplus could be anything that's better than that. A true surplus is anything to the positive. So any revenue minus expenses on the positive side could be considered surplus. So there's lots of different ways of calculating that, but as I have done in the past, I took a planning surplus to mean what did we budget for and where did they actually come in. And anything better than what we budgeted for, I would consider a planning surplus. So that's the breakdown up on the screen. It tells you that we budgeted a deficit in the planning department of $584,000. They actually came into the good of over $500,000. So if you look at it, there's a surplus in the planning department of $1.1 million. So my first recommendation is the 458. You take that off the 1.1, and that leaves 644,050.
458 being the amount that we took out of the operating reserve in 2017 to fund contract positions and whatnot.
Yeah, the resolutions council made to increase
Right.
the 2018 budget.
Yeah, so in essence, for the planning department, that reserve is like a bank account. I mean, it is a bank account.
Yeah.
Because no doubt in 2018, things are going to come along where we are talking again about adding contract positions or some sort of short-term expense that wasn't in the operating budget. So I think it's a good suggestion to replenish that operating reserve, at least the amount that we drew down from it, specifically related to planning.
So that's how I got the
Yeah.
$50.
Works well.
All right, and the reason I'm making that recommendation is housing, affordable housing is still a council priority, so there will be more coming, I'm sure. So what about the asset rehabilitation and replacement reserve recommendation? So where did I get that number? Well, that's just the leftover. How much is left after we make the other allocations that I'm recommending? And the reason why I'm recommending that we look at putting it into the asset R&R reserve, to save my tongue from tripping over all those words, is the projected December 2018 balance is $1.6 million. But the target is to help us fund all the rehabilitation and replacement projects that were identified in the long-term financial strategy. So that target is still being worked on as to what should be in the reserve, but I can guarantee you it needs to be more than 1.6 million. So that's my recommendation, is to transfer the balance of the surplus from 2017 into this reserve. And just a reminder, in the current strategic plan, reserves are still a priority of council, and they were for 2017. So, alternatives. You could direct the surplus to any other reserves as you see fit. You could use it to reduce the 2018 tax requirement. So we did consider that and did some analysis on it and looked at it and are not recommending it. So when at budget time, we budgeted that the next net tax increase would be 3.7%. And we thought that there would be $150,000 collected from real growth. So new taxpayers would pay $150,000 of the increase. When I crunched the preliminary numbers in preparation for this meeting, it looks like the additional tax from real growth will be $340,000. So that reduces the municipal tax increase to 2.9%. So 3.7 down to 2.9. And also another thing to consider, and why we aren't recommending we reduce the tax increase, is our residential tax per dwelling information that's in your package later on when we talk about the property tax rates. We're actually below our neighbor's average, and so it didn't seem prudent to bring us even lower than the average. So for those reasons, that's not our recommendation. Our recommendation is that you see up there, and I'd welcome any questions that you might have that didn't get a chance to ask during the presentation.
I have a question that I'll ask because this is a public meeting, and I've asked outside of the council chamber around the surplus in the planning department. Noted there was a lot of permits and a lot of work that was done in 2017 that hadn't been imagined, and I just wanted to be certain that none of that surplus is attributed to planning work that has to be done yet, thinking specifically of Three Sisters lands, or so we don't have a surplus because they've paid us already and we just haven't done the work. That's the question.
Yeah, part of it is. Yeah.
Part of it is.
Part of it is. So we collect the fees, and then there's work that has to go into each application. I'm hoping someone over here might have more specifics on that.
Yes, I don't know exactly what, for example, Three Sisters paid in 2017. I believe the bulk of their payments came in 16. There were some installments that were laid out, and I believe the final installment for Three Sisters was supposed to come when they made application for Smith Creek, and then that application got pulled. So I'm not sure that we received any funds from Three Sisters in 2017, but certainly part of the surplus that potentially was allocated in 2016 was related to planning fees associated with that development. And
right. So we're not treating the surplus purely as surplus. I don't know how to ask.
We're not banking those revenues for use in the time when we're doing the work.
Right. So the work, if the work still had to be done and it was paid for, it's not surplus.
If I may, I think that was part of the thinking behind the resolutions that were made early in the year in regards to the 458,000, was we anticipated that there would be some work that had to be done falling out of revenue received in 2017, but we knew the work would have to happen in 2018. And I believe that that was the thought process behind the council resolutions, to increase contracted services, to give money for more planning workhorses to be able to do the work, and to shift that. So that $458,000 does consider that's the work we collected the revenue for in 17 will be done in 18.
So that's already part of the consideration that
Yes.
resulted in these numbers.
Yes. And that's an estimate, and it's hard to know the exact.
You know, that was the answer I was looking for. Oh, sometimes they don't understand what I'm talking about over there. Okay, other questions? Not a question so much, just as an observation, because this is part of the discussion every year at this time is, often, I should say, there's another possible use that's envisioned for reserves or surplus funds. And the conversation always, in the past, has come around to recognizing that by putting surplus into various reserves, it's therefore available for other things that come along that we're not talking about immediately today. So actually putting the surplus into a number of reserves is a safe place to put it. It's like putting it in the bank and we can draw it out. Granted, I mean, recognizing certain reserves have specific uses in mind, but so not a question, just a general observation. Are there any questions? Seeing none, thanks for
Thank you.
a very detailed report.
Thanks.
Easy to understand. And then at this time, I'll move that the Finance Committee approve allocating the 2017 operating surplus of $2,701,225 through transfers to reserves as follows. $458,000 to the General Municipal Operating Reserve, $273,000 to the Tax Stabilization Reserve, $644,050 to the PAH Reserve, and $1,326,175 to the Asset Replacement Rehabilitation Reserve. Is there discussion on the motion? I'll just acknowledge that the recommendation is really solid, is well argued, well developed recommendation, and you know, through the last couple of weeks thinking about this, I thought, well, maybe, you know, we should put a little bit over here or do something, you know, reduce the tax cost. But all of the arguments, all of those possibilities have been really well answered in your presentation. So I'm quite happy to support the motion. I think it's good to be topping up reserves in this fashion. Does anybody else care to comment on the motion? Seeing no interest, I'll call the question. Those in favor? Opposed? Motion's carried unanimously. And that will move on to item D3, 2017 completed capital project summaries.
Okay, so in the previous report, we gave you all the information about all of the projects. So as is our practice, and I believe our policy, we are now today reporting on all the capital projects that got completed during 2017 with a little bit more detail. So there is in your package a sheet for every project that was completed in 2017. So to give you a summary, and again, I'm not going to go into each sheet. Phew. So there were 65 completed capital projects during 2017. 49, would you like to say goodbye?
Yeah, goodbye, Mr. Scott.
Bye, thank you.
See you next year.
So there were 65 projects that got completed in 2017. 49 projects were worked on, but still need some more work, so they were carried forward or whipped into 2018. 4 were transferred to other projects, so that's what I was talking about. Sometimes people will want to amalgamate projects, so the budgets were put together, and that was always by council decision. And 11 were canceled. 10 were approved as part of our budget amendments process, and we thought we would be going ahead with the utility bike project, but it was determined that there really would not be a take-up and a need for it. So rather than spend money for the sake of spending money, prudently made a choice after analyzing the project, and are seeking council's authorization to cancel the utility bike project. And that sheet's in amongst all the other capital closeout sheets, but I made it also another copy in the last attachment, so you wouldn't have to dig through your package to find it. And so, for those reasons, I have a couple of more recommendations for you to consider. Did you have any questions?
Few, perhaps. On attachment 1, the 2017 capital and project status. So in the project status, there's a few that are noted to be, rather than work in progress or complete, noted as transfer with a number. So the transfer, for instance, looking at 1718 CRC special needs, the status is transfer number 1615. What does that mean? Tell me what that means.
I'm going to ask the producer of the report, Mr. Irwin.
The whole budget was transferred to project 1615.
Project 1615. Right. And is project 1615 from 2016? Right. So the projects approved in 2017 were transferred to earlier capital sheets.
But it's still ongoing.
It's still ongoing, yeah.
Yeah, so 1615 is still a work in progress.
So it could have been noted work in progress, but this is, I mean, it's work in progress.
Right. Yeah, so originally when the budgets were approved in 2016, it was anticipated that there would be 2 different projects through a report to council. It was determined that it actually is 1 project, so sought and received council's permission to amalgamate the budgets for those 2 projects, hence the wording transfer to number 1615. And then when you're looking at the budget for 1615, if you look at the original budget and then you look at the one now, it will be amalgamation of the 2 projects, or whatever was all amalgamated together.
Yeah, I know it's been a long, complicated
I know, it's,
path. Maybe that column could have noted transfer 1615 WIP, just so, I don't know. But I get it, I understand now. The project 1748, the parks, Washroom Riverside Park, I must have blanked out at some point because I don't remember it being canceled. When did we cancel that?
we canceled it because no money had been spent in 2017, and then we re-stuck it in the budget for 2018.
Shows up in a different budget.
Yeah, because our rules are that if you don't spend any money in the year,
Yep, I remember that now.
yeah, and that's why we couldn't start it, was we were waiting for provincial permissions because it's provincial land, so we couldn't get the
Right.
project started, but we still feel it's
Yeah,
a project we
right,
need.
so, right, I mean, we canceled that, but we started it under a different project number.
Yes.
That's what I had forgotten. The, every time I look at any of these reports, I wish there was a way we could just combine all of the Fire Smart into one project. It's so hard to follow the Fire Smart work. It shows up in so many different numbers. Is there any way that maybe we can consolidate all of that into one?
We'd have to look and see it, because a lot of times Fire Smart is grant funded. So in order to facilitate grant reporting, we would need a separate accounting for each specific grant. Without looking at it in detail, I don't know if that's the case, but I think where there's an opportunity, we can certainly look at that, but I can't promise we'll be able to put it all together.
Is there somewhere I can go to simple it in a simple way to get the whole picture on fire smarting? Because this fire smarting is becoming a more topical issue these days, at least, certainly in a lot of talk. And I know that we put a lot of resources into that project and have for years, and that's been acknowledged by within the reports done by outside sources. But if I wanted to say to somebody, oh, well, you know, over the last 6 years, here's what we put into fire smarting, I would have to go back to each year's budget and sort of tally it, or is there some central location that has all the detail? Ms. DeSoto?
No.
that something we could do just for information?
Well, if council would like that information, we can have our fire chief pull that information and present it in a report. But that, just like street improvement budgets that happen every year, or utility infiltration and inflow projects that happen every year there's a separate street or a separate area of town that sort of gets. So yeah, short of going back and looking at every budget, there isn't a button you can press and get a summary.
And I'm not suggesting that we need to ask the chief to do that. Dr. Cottle?
I will just remind council that next week we do have fire mitigation strategy on the agenda for the council meeting, and the consultant who has overseen the majority of that work, the fire smarting work, will be presenting. So he will be able to speak to it at a high level in terms of where the work has been done and what's been done. If you do want specific details, that's something we'd need to generate, which we also can do. We just need direction from council to do that. But the consultant will be here next week and will be able to speak to it at a high level.
I think that's why this is on my mind, because I've read the draft agenda for next week and his report, and just top of mind for me. Councillor Sanford.
Thank you, Worship. A question about, for example, the project 1627 that was cancelled. When that funding is no longer required and it's a 2016 budget item, does that go into this year's surplus?
No, so this is capital budgeting.
Oh, okay.
And so
Right.
surplus is operating.
Okay.
Right? So I haven't looked at how this project was budgeted to be funded, but say, for example, it was supposed to be funded from the general capital reserve. Well, we would only withdraw from the general capital reserve the actual dollars spent.
So it just stays in there?
So it just stays in there.
Okay, so we don't reallocate this?
Yeah.
Okay. That's, the capital closeout sheets reflect,
Yes.
all of them reflect that? Okay.
Yes.
All right, thanks.
I would just turn to attachment 2, the projects carried forward to 2018, and first one, and it sort of sparked the thoughts I had that we're just talking about. So we'll go right back to 2013 with that project 1311, and yet there's still, a 2018 work in progress budget associated with that 5-year-old project. So is that it's confusing. I mean, there's something, a $305,000 budget for 2013 is still being whipped. And I know over and above that specific project, there's other Fire Smart projects. Anyways, yeah. And on, again, projects carried forward to 2018, Project 1711, the replacement of Pumper 31. So under 2018 work in progress, that 844, 870, I'm assuming that's like the final full-on price. That's
Well, so the carry forward is 850,000. There was the original budget, less the amount that's been spent to date, is $844,870. So that's the amount of the budget that's being carried forward into 2018. So it's not reflective of what the cost
so
is.
that's not the actual cost of the pumper.
It's just the leftover budget.
Right. Right. Okay. I'll leave that. Are there any questions from other councillors for related to attachment 1 or 2? looking through attachment 3, all the project closeout sheets. If there's any questions, comments? Not any for me. Okay, I guess there's no questions on attachment 3 either. So unless there's anything else from the Finance Committee for Ms. Van Kuympema. Thanks again for a fulsome report. This time then, I'll move the Finance Committee accept the 2017 capital project summary as presented. Discussion on that motion. Seeing none, call the question. Those in favor, opposed, motion's carried unanimously. And I'll move that the Finance Committee cancel capital project 1743, utility bike. Discussion on that motion. Seeing none, I'll call the question. Those in favor, opposed, motion's carried unanimously. Moving on to item D4, preliminary property tax rates. Ms. Van Kuympema.
A little preview of things to come on May 15th, which will be when you set the property tax rates for 2018. A bit of this is a repeat. I think during council orientation, I kind of use these same slides, so apologize for repetition, but I have yet to find a better way to try and explain how we get to our property tax rates. So preliminary property tax rates have to set it by bylaw, so, and you can't, council can't delegate the passing of bylaws. So therefore, to the Finance Committee, I can just give you a briefing of the preliminary reports, and then I have to bring the actual bylaw to council, and that's scheduled for your May 15th meeting. So we have prepared the rates in accordance with your tax policy. So that's the policy we're talking about, and there is one, and I printed out in case there's questions on how we split stuff up, but that's where I start. Figure out how much money do we need, then I go look at the tax policy, and it kind of guides me as to how to start figuring things out. So right now our policy is that vacant land that's serviced should be taxed at the same rate as residential properties, that our tourist home tax rate is 2.9 times the residential rate, and that we keep an eye on our neighbors and our competitors and see what their split between residential and non-residential is doing, and not that we have to be exactly on average, but to keep an eye and make sure we're still in line with them. So that's all part of what's in this report. So all of that goes into calculating the numbers. So, talking about pies. Well, not that kind of pie. Probably not the next kinds of pies either, but it's an easier way to try and help explain how this all works. So we have, actually this year we have a 5th pie, but we'll talk about that later. So right now we have 4 pies. Council is responsible for 2 of the pies, the municipal taxes and the PAH. So you get to decide those pies. Then there's the seniors requisition, so Bow Valley Regional Housing decides that pie, and provincial education taxes, though that's the pie decided by the province. So we have control over municipal taxes and the PAH, and when I talk about a pie, I'm talking about the total dollars needed to be collected in order to meet our budget requirements. That's the PAH, or the municipal taxes amounts, those are those pies. And then the seniors requisition and the provincial education taxes, those pies are ones that are handed over to us and said, fill this pie crust. This is how much filling you need. And then you have to give us that money. So what we're looking at right now is the municipal pie has increased $964,000, 1.5% of which is coming from growth. The PAH pie increased by $5,000, which was less than 1%. The seniors pie actually decreased by $109,000, which in relative terms is a 10.5% decrease. The education tax increased by $1 million, and that's a 6.1% increase. Then I talked to you about a fifth pie. So with the new Municipal Government Act, the province now has taken over assessing industrial, and they used to always assess linear properties, but now they've taken on industrial. And now they're going to ask those properties to pay the costs to perform those assessments. And they asked us, sent us a requisition and said, you need to collect a pie from these linear and industrial properties and send us the money. So that pie is new this year. It's $1,616. So it's not a big pie, but it's still another pie.
That's just the assessment costs.
Yeah, for linear and industrial property. Yeah, just the assessment costs.
We don't collect a lot of linear industrial tax anyway.
No, we don't have a lot of those properties.
Yeah.
They tend to be mostly in rural municipalities.
Yeah, I think the MD has more preponderance of their taxes linear, isn't it?
Yeah, and different ones like Strathcona County has a whole bunch. Yeah. We, not so much.
Not so much.
No. Okay, so those are the pies that we have to deal with. So a pie is just how much money do we need to collect? Then I need to go and figure out how much do I need to collect from you and you and you and every other individual person. So how do we do that? Well, that's how we figure out how to set the tax rate. So that's the slices of the pie. The pie is what it is, and now if you have a bigger pie, you're going to have bigger slices. But not everybody's slice is going to be bigger. Some people's slice might be a little smaller than it was previous, and other people's slices will be bigger. So it's always a fun way to try and explain how this works. So I'll try my best here. So the first thing I do is I say, okay, I've got this pie for municipal taxes, and the first thing I got to do is figure out how much of the pie I'm going to collect from our residential taxpayers, and how much of the pie are we going to collect from our non-residential taxpayers, and that's that split. And that's the one we look to for our neighbors and our competitors and say, what is the percentage of your taxes that you're collecting from residential taxpayers, and what is the percentage from your non-residential taxpayers? So we have historically in the last few years gone with 65-35. Looking at the comparables, it wasn't that far out from the 65-35, so I didn't see any reason to move away from using that split. So I take the pie and I lop off 65%, and start doing calculations with that, and I take the other 35 and do the non-residential calculations with that. So that's the first step. Then the next step is I take the residential 65% and then I start slicing it between categories of residential taxpayers. And then once I have that slice, I'm going to divide it into Councillor Hillstead's tax bill and Mayor Borrowman's tax bill, so individual slices of that residential slice. All right, so what are the slices? So once I do it all and you add it all together, I take a look and we determine the slices, individual slices, and classified pieces of slices by the assessed value of the property. So I add up all the properties that are in a residential classification, and we get a number. The total assessment equals a number, and the tourist home is another class, and the tourist home personal use, and all the way down the line. So that's the names of the bigger slices. The things that go into residential slices are from residential to vacant serviced. That's all considered to be residential property. And that's the 65% of the tax bill gets paid by those taxpayers. The 35% of the tax bill, or the pie, comes from the next 4 properties, which are all non-residential properties. The last on the bottom here is the amount of assessed value that goes to properties who don't contribute to helping eat the pie, so to speak. And those are the exempt properties. So those include ones, and earlier in the year we talked about exemptions and how I said most of it's our own land, so it didn't make sense to tax ourselves, but it includes any kind of properties that have any kind of exemptions. So some of the properties council exempted from everything except PAH and seniors requisitions. There's some properties that are exempted from everything, so that's just all lumped into the exempt, and I gave you the assessment so that you could see the changes in the value from year over year, but they don't help contribute to pay for the pie. The other thing to make a note of is that each year property owners of tourist homes have an opportunity by January 31st of each year, if they're not going to rent out their property, they're only going to use it for personal use, they can sign a statutory declaration, and that's an annual thing. So the movement and the changes in the total assessed value for tourist homes and tourist home personal use are affected by how many people have signed the statutory declaration. There might be more or less in a particular year. In 2018, 148 properties signed a statutory declaration, and in 2017, 159 had. So there's 11 less properties who signed the statutory declaration. That's a 2% drop. The other thing to remember is that electrical generation and machinery and equipment, they don't pay education taxes, so that makes it more on the remaining taxpayers. Thing to just to sort of give you some information on, I talked about in the report real growth and market growth. So real growth is new people who have property that wasn't here before, that are helping to carry the burden. And that real growth was assessment of $65.8 million real growth. The market growth is existing properties. What are they worth now? One could consider it to be inflation or the market movement of each property, and that contributed $137.2 million to the increase in the total assessments. So, gives you an idea. So, there's always a, how am I going to explain? How am I going to explain things? And so one thing I've done in the past is calculated an average. So in basically what I do is I take each classification and I say, okay, the total assessed value is this much. How many properties are in that total? And that's the average. And I do that for each year. So that's what this slide is, and that's what's in your report, is just to give you an idea of how the average has changed. Some of that's due to real growth, some of that's due to market growth, some of that's due to, especially in the tourist homes, where they're shifting between classifications. So it just is a snapshot, and it's just a calculation. And that's how I got those numbers. So then, once I've split up the pies and the slices and everything, then I start trying to figure out, how am I going to figure out how much I have to charge each person, or how big is each person's slice? And we do that by setting the mill rate. And the mill rate is simply taking how much money do we need to collect from this classification of taxpayers and divide it by the amount of assessment in that classification of taxpayers to figure out a factor, which is the mill rate. And then we apply that factor or mill rate to your assessed value to come up with your tax bill. So the preliminary tax rates, and this is based on a pull of our assessment data as at April 10th. Up until May 9th, taxpayers have an opportunity to talk to the assessor, find out how their numbers were come about, see if they can come to an agreement. If they don't agree, perhaps the taxpayer has some evidence they'd had an appraiser in and they had quite a bit of different numbers. So there's always adjustments to these numbers up to the assessment complaint date of May the 9th. So these come from April 10th. The numbers I will bring you will be the most up-to-date and accurate I can when we get to May 15th, when we set the tax rate. So preliminarily, those are the tax rates. One thing to watch out for, the new Municipal Government Act says that your ratio of non-residential to residential, how much tax is the non-residential taxpayer paying in proportion to the residential taxpayer, cannot be greater than 5. We are at 3.26. So we're nowhere near that 5 limit, and that actually comes out of the Property Tax Task Force work that we did, where we looked at that, and we said we need to be more in line with the average, and that's helped that, because there are some municipalities that are above that 5. 2.9 tourist home, or 2.9 to 1, which makes sense, because we've said tourist homes will be 2.9 times the residential tax rate. Vacant land, serviced land would be the same as the residential, so that ratio just reinforces that we are in compliance with our policy and in compliance with provincial requirements. So it gives you preliminary tax rates there. So what's the impact? Again, this is always how you're going to do it. Averages, so the averages are impacted by the number of properties that are in there, the real growth, the market growth, and so just looking at the average, it's not always going to be exactly the easiest way to explain it because not everybody has an average property. So I thought, well, what's another way of explaining it? And I'm always looking for better ways to try and explain it. So I did prepare something. So if you look at the impact per 100,000 if you don't take the average, like you just say $100,000 in 2017, $100,000 in 2018, how much more tax would I pay on that $100,000? And if I'm a residential taxpayer, it's $5. So I don't know if that's more helpful. So if you just say, if my assessment this year is $700,000, so 7 of those times 5, I'd anticipate $35 more that I'd have to pay than I did in 2017 for municipal taxes. If I had a $300,000 condo, I'd pay $15 if it's a residential property. So that's what this slide kind of says. And basically all it is I'm talking about the change in the mill rate in dollars. So the 2018 mill rate is $5 per 100,000 more than it was in 2017 for residential. For non-residential, it's actually gone down. It's $31 less per 100,000. But there are bigger properties that went down, but there's other properties that are non-residential that went up. So that doesn't mean that all the non-residential taxpayers are going to pay less. There's probably a couple of big ones that will pay less, and the rest will pay more. But again, just looking at the mill rate. The mill rate is $31 per 100,000 less than it was in 17 for our non-residential. Okay.
$5 for every 100,000. That's another easy way of.
Yeah, municipal taxes. Right?
Yeah.
Okay. So we're in our tax policy. I need to report on our competitors and our neighbors because that helps us figure out the split. So just to let you know that competitors, they're the same competitors that we've used in previous years. And in previous years, actually in our tax policy, it says give us the per capita number. Starting last year, we said per capita is kind of problematic, especially here in Canmore, because we have a relatively large non-permanent population, and that's not in the numbers, and there might be the same case in others. So we didn't feel we were comparing apples and apples and oranges to oranges. So what we did is we changed it last year and did it on a per dwelling basis, which seems to make more sense for our community. And that information is available for other communities as well. So looking at it from a competitor standpoint, our average taxes for a residential taxpayer is actually slightly higher than it would be for our competitors in 2017 as well. So and it gives you what's the tax share and the assessment split and all of those information in the statistics that the tax policy has us look at. So that's neighbors. On the other, that's competitors. On the other hand, their neighbors, we're actually, our average tax per residential tax per dwelling is below the average of our neighbors. So it all depends on what group you're putting together and how you compare.
I think one of the factors that informs that difference is in the competitors, most of them are BC.
Yeah.
BC has a different revenue potential for the municipalities, so they don't depend as much on residential taxes as we do. Whereas when you look at the neighbors, they're all Alberta, and as you've noted, our tax per dwelling compared to Alberta properties or municipalities is good. So there is a bit of a nuance in that top chart, comparing on the competitors, most of whom are BC.
Yeah, and I sort of had alluded to that earlier when we were talking about what to do with the surplus, in that, looking at our residential tax per dwelling, looking in comparison to our neighbors, we are lower. So that's what I had alluded to, and this is the information I was talking about.
Councillor Sanford.
Thank you, Your Worship. In regards to where the growth was, did it grow more on the commercial side? than on the residential side?
I have to go to the actual calculations of that, which I do have here, so I'm just going to talk while I'm searching. So yes, there is different classifications moved at different rates. I'm just trying to see where I printed that out. And, oh, look, here it is.
I'm sure it's there somewhere.
Yeah, it's like, I got enough pieces of paper. All right, so if I look at residential, it went up about 2.9%. There's other ones that decreased. Non-residential, for the most part, if you took out the linear components of it, they actually increased by about 3.8, if I'm recalling correctly. I didn't print the one with the percentages on it, but so it does appear that the non-linear, non-machinery and equipment, non-residential properties, lots of nons, did increase more than the residential properties.
So would that not be an opportunity for us to change the tax split slightly to reflect that?
That's always an option. And that's sort of another purpose for bringing it to the Finance Committee ahead of bringing it to the Council for approval is, you know, if you want to consider doing something different, then it would be a great time to talk about that.
Because if it's going down on the commercial side and up on the residential side, if we adjust the tax split, that would bring it more. Yeah,
I also caution you that some of the commercial or the non-residential properties include, for example, visitor accommodation properties or small business owners. And so they're just didn't necessarily decrease by $31 because it's affected across the board. So if you were to increase, not everyone has that $31 decrease that's going to affect them. Does that make sense?
And then I'm just looking at the chart that you gave us on page 166 about the average assessment. And the percent change in average assessment on residential, it was 2.7%.
Yes.
And on non-residential, it was 8.9%.
Yeah.
So,
so if you look at it, I was thinking about sort of, you know, machinery equipment in there too, and going over and looking at sort of the whole category of non-residential. But yeah, so that's the chart. So if I'm looking at sort of how did the average change, part of that, like I said, is the number of properties in there, because you're just looking at the change in the average. Part of it is real growth, part of it's the market growth. So those numbers are got a lot of factors that go into them.
It's not a straightforward linear discussion. It's more because it's average.
Yeah, and none of and the only way to have a straight and linear discussion would be to pull up a specific property and say, in 2017, this specific property paid this much in municipal taxes, and with these rates in 2018, that specific property will pay this much money. And but that may or may not be reflective of everybody's bill.
Yeah, but when you look at the per 100,000, that's a good comparator because everything is per 100,000. So that doesn't necessarily say the average. It's like per 100,000, right?
Yes.
So that's going to show you what your increase or your decrease is per 100,000.
Right, of municipal taxes, And
of course, the other factor that people sometimes forget is maybe their assessment's gone up or down. So they're no longer 700,000, they're 750,000 or whatever. So they'll just look at the actual tax bill and say, well, it went up more than whatever. It is complicated.
But if your assessment goes up several 100,000 and that dollar figure is attached to it, then that's a real gain.
But if the tax assessment's gone up, people are still comparing their old tax bill to the new one. They're not thinking about the fact that there's $300,000 or whatever additional assessment. It's just, what did I pay last year? So it's more than what, anyways, it's complex to explain, isn't it?
Well, I know, and visitor accommodation tends to go significantly up or significantly down too, and that's in the non-residential category. So that is also affecting non-residential right now too. Yeah,
you know, and with the recovery of the economy, we're seeing the prices of the visitor accommodation units starting to come back up, where there was a couple of years where there was significant drops. So it's
they have the benefit of the short-term rental, right, which is a very desirable thing right now. So they pay a tax rate that's requisite with that benefit. And so, I mean, it's a good opportunity in Canmore to have a short-term residential opportunity like that, so. And obviously, the market is saying it's good too because it's going up.
Yes.
Okay, thanks.
Are there any questions at this time or comments? Understanding that this will come back in a more formal format and part of a bylaw that we'll have to approve.
Yeah, so if there's anything you would want to consider that might aid me in preparing the bylaw for your consideration, if there's consideration to changing the split between the residential and non-residential, or perhaps you would like to consider a different ratio of tourist home, or like whatever, if there's some changes from what these recommendations are, it would be helpful to hear them today, because then I could be able to crunch the numbers and have that all prepared for you on May 15th.
Because as of May 15th, there's not a lot of time left to...
Well, we set things on May 15th, and then that's what it is. So
Right.
if there's assessment changes or something happens,
Yeah.
I don't get to come and make up for the taxes we didn't collect.
No. I mean, the bylaw has to be approved at that time.
Oh, well, so we can put it later. However, the due date for the taxes is June 29th. So I've chosen to bring it to the council meeting as we traditionally have the second
Yeah.
one in May, to allow us time to print the notices and give people a reasonable amount of time to pay before June 29th.
Well, at this time, I'm not thinking about any suggestions to make at the May meeting, so I don't know if other councillors are and want to have some conversation about that in this forum. Doesn't look like it. I think if you bring it forward as detailed in this report, that's probably going to work pretty well. And there's no motion associated to this item, so
No,
thanks.
it was just presented for information, and if you wanted to have a discussion.
That's great. Thanks very much.
Thank you.
Whew, long meeting for you and a lot of preparation.
One whole year.
So at this time, I'll move the Finance Committee be adjourned. Those in favor, opposed, we're adjourned.